want to start by saying Happy New Year. It's 2017. We're going over our trading plan. We're looking at one of our top strategies here, Tick Pulse. One of the best things you can do for your trading is to wait for a drawdown to start a trading system or a drawdown in a portfolio, and you see the drawdowns in the equity curve. This is Tick Pulse with $25 round turn slippage and commission. You see all these little drawdowns here, and these are good places to start because you reduce your risk to the worst case drawdown, and you're not buying an equity peak. It's challenging to buy an equity peak. Sometimes it's the best thing to do. If you bought this equity peak, it would have turned out nicely. If you would have bought that equity peak, each green dot represents an equity peak, but it's somewhat psychologically easier sometimes to buy a pullback. It's like buying a dip in an equity when you're looking for an investment. And so you've got this trend line too in the equity curve. And so that's not the straightest line, obviously, but buying these dips in this equity curve and starting a strategy when it's in a little bit of a drawdown is one of the best things you can do, and that's what we're recommending in Tick Pulse, one of the strategies in our portfolio. And here are the results. Again, this has $25 round turn slippage and commission taken out, and so this number is almost $67 without slippage and commission, which is a good number, and about 50% profitable. And so it trades more frequently, and the profit factor is 1.26, 42.1250 drawdown. You can see that most of the winners are on the long side, so it would be easy to bias this. It's over $100 on the long side if you take this strategy long only, and you want to anticipate that going forward. Maybe a good bet. You know, we might have some sell-offs here and there, but this market is pretty strong, and there's a lot of bullishness in this market, so trading the long side might be the best way to go. All the profits, once again, in the past since September 2015, have been on the long side. So again, here is the equity curve. Here are the periodical returns at 14,137.50. We designed this at the end of 2015. And here is the monthly results, minus 925 in December, so it was a down month. You see there are up and down months, and you see that here's a period that's about 2 months long, has about the same amount of loss. Some of these drawdowns are quicker, and so you still see the profitable months. And so just last month it was almost 4,000, and then in September it was 3,300. So highly recommend this strategy if you want to trade a single E-mini S&P trading system and you want to quantify your risk to worst case drawdown. You can jump in on this and have about a $2,000 or $3,000 risk to worst case drawdown and have a strategy for 2017.